next guest expects the Fed to ease rates in September and in November this year. Darrel Cronk is Chief Investment Officer for Wealth and Investment Management at the Wells Fargo Investment Institute. Darrel, it's good to have you. You're even going, you think they go in the election month?
Yeah, I think they will. I mean, and I think what you'll get is, if you include tomorrow's CPI report, you'll get 3 more CPI readings and 2 more PCE deflators, which the Fed cares more about PCE deflator, which the latest readings are at 2.6, a stone's throw away from their range of 2 to 2.5. So I think they'll get what they need to go ahead and make that first move in September. They also keep it away from the November election, right? So you don't have to worry about that being the argument. And then we still think they follow through November. And remember, the November Fed meeting is after the election. So
True.
It's not before.
But, I mean, all the speculation kind of happens going into that. Even now they're under pressure. You kind of got that vibe with some of the questions in front of Congress the past couple of days of those incumbents who had hoped that rate cuts could help them keep office.
Yeah, I think that's true. I think there's other, political winds blowing and brewing there that will be more important than interest rates and what's happening. But, what people forget about inflation, and I think is really important, is inflation is a price increase over a time period certain, month over month, quarter over quarter, year over year. So even if prices are only going up at 2 or 3 or 4%, they're still going up, right? So consumers that are stretched and having a difficult time paying 7 to 8% for mortgages, or 15, 16% for auto loans, or 22, 23% on their credit cards, right, are still feeling the pressure as they're living paycheck to paycheck. And we see that in the consumer data.
Let's talk about kind of tactically what you're doing. All of the debate and discussion has been around, do you kind of lean into the momentum trade with tech and AI or lean against it? And you seem to be moving to neutral on that area. It's not you're not underweighting it, but you're kind of saying maybe lean back a little bit. Why?
Yeah, I mean, obviously, big win that we're 5,600 on the index. But what's important and what people aren't paying attention to today is, if I look at all-time highs on the S&P at a market cap weighted index, the reality is, if I go below the surface, the number of members of the S&P 500 that are above their 200-day moving average are at a new low for 2024. Right? So what does that suggest? It suggests breadth is very narrow here again. We've known that for some time, but it continues for that, right? So even though you've got the critical few powering on, the reality is they're still going to put up, those big tech names are going to put up great earnings growth this quarter, but we just find there's other value in places like industrials, materials. We think healthcare can be a good value and be a little bit defensive at reasonable valuations. And we love energy. Energy is our favorite GIC sector at this point.
I mean, the valuations there look super compelling, but, the stocks have a hard time sometimes breaking out to the upside. I thought it was interesting you talk about a little bit of a defensive tilt, even though you think the economy is going to reaccelerate in the fall. Is that right?
Yeah, I mean, look, we had 1.4% Q1 GDP growth. We're on pace to track right at 1.5 for Q2 when we finally put it in the books here. The second half to us, though, looks a little bit challenged. I think those higher rates and the sustained inflation grinds a little bit on the consumer and on spending. Housing looks like it's weakening a little bit. So I do think the second half weakens a little bit. Is it enough to throw the economy into recession? Probably not. But it's not going to turn around and reaccelerate, even if we get the 2 Fed cuts.
So you don't think it's going to turn around and reaccelerate even with the Fed cuts?
I don't think economic growth is going to turn around and reaccelerate. So I think you're going to still stay at this kind of downshifted trend to around 1.5% to 2% growth, which by all accounts meets this definition of soft landing, no landing. So we avoid the recession. That's a good news story. But again, that's priced into the baseline here, right? And so I think if things continue to slow and soften from here, and you maintain, some level of inflation, I think we're going to test the consumer and the labor market, right? And those are the 2 linchpins that need to hold for the risk assets in the stock market to continue to go higher.